Imagine looking at the financial statements of a company that, just brought in $2.6 billion in a single quarter.
Right, which is just a staggering amount of cash.
Totally. And not just brought it in, but literally doubled their revenue from the year before.
Yeah.
And then you scroll down this earnings report and you see they have legally locked in over $100 billion in future contracts. I mean, customers are literally lining up, begging to pay them.
Begging. They can't take the money fast enough.
Right. So you'd think the bottom line of that earnings report would be like printed in gold ink, wouldn't you?
Yeah.
You would expect a massive historic profit.
Of course. That's just basic business logic.
But then you get to the final line, the net income. And it hits you with a $626 million loss.
Yeah.
A massive glaring red number. 3 months of work, billions of dollars moving around, and officially they lost over $500 million.
It feels like a glitch in the matrix when you first see it.
Oh, absolutely.
Or at least a fundamental violation of how we're taught business is supposed to work, right? You take in more money than you did yesterday, you should be profitable.
Exactly.
But the landscape of hypergrowth tech, specifically this infrastructure layer we're looking at today, it completely shatters that traditional gravity.
Well, welcome everyone to this special Talk Tickers edition of our deep dive. For those of you joining us, our mission here is very specific.
Very specific.
We take the latest, most complex, and frankly, most overwhelming corporate earnings calls.
Yeah.
And we break them down for you, the retail investor.
We cut through all that corporate PR spin.
Right, stripping away the impenetrable Wall Street jargon and delivering data-forward, actionable insights. And today, we are opening up the Q2 2026 earnings call for CoreWeave.
And this one is, it's a monster.
It's a total monster.
Monster is truly the only appropriate term for the scale they're operating at right now.
Yeah.
If we look at the underlying current driving every single metric in this call, it really comes down to this fascinating tension. CoreWeave is executing on their top-line revenue growth with a level of aggression we rarely see.
But the costs, right?
Exactly. The sheer physical cost of building the infrastructure to support that growth is requiring cash outlays that just, defy belief.
I was reading through the source transcript before we sat down, and I found myself repeatedly stopping to count the commas.
Right. The zeros just keep going.
The numbers are so large, they almost lose meaning if you don't contextualize them.
Yeah.
So let's not just read the numbers. Let's actually figure out what they mean for the business.
Sounds good. Let's dig in.
Let's tackle that paradox I mentioned right at the top. The top line, the revenue. They reported $2.6 billion for the second quarter.
Massive.
That's a 112% increase year over year. And perhaps more impressively, it's a 24% jump just sequentially from Q1.
Yeah, that sequential number is huge.
I mean, they're growing by a quarter in a single quarter.
And that sequential growth is actually the metric institutional investors watch closest in this sector.
Oh, really? Why sequential over year?
Well, year over year is great, sure, but sequential growth tells you if the engine is stalling right now.
Ah, I see.
A 24% bump in 3 months means the demand curve is still accelerating. It's not flattening out.
Okay, so top line is incredibly healthy, but then we get to the profitability metrics. And this is where I really need you to translate the Wall Street terminology for us.
Happy to.
The call highlighted an adjusted EBITDA of $1.5 billion.
Right.
That represents a 59% margin.
Which is fantastic.
Now, 59% sounds amazing, but what exactly does EBITDA measure in this specific context?
Oh.
Like, break it down for the retail investor.
Right. So it is the most crucial metric for understanding a heavy infrastructure business. EBITDA stands for earnings before interest, taxes, depreciation, and amortization.
Okay, that's a mouthful.
I know, it's a ton of accounting terms, but think of it as the raw cash generated by the day-to-day operations of the company.
Before everyone takes their cut.
Exactly. Before the banks and the tax authorities take their cut and before the accountants apply, theoretical wear and tear to the equipment.
So if we strip away the loans and the accounting rules, the actual business of renting out artificial intelligence computing power is wildly profitable.
Incredibly profitable.
For every dollar they take in from a customer, 59 cents is pure operational profit.
Yes. The core engine buying a server and renting it out is a highly efficient cash machine. The $1.5 billion EBITDA proves the business model works phenomenally well, which makes the ultimate bottom line all the more jarring to a casual observer.
And there is the whiplash. because you scroll past that $1.5 billion operational profit, and the officially reported net loss is $626 million.
Yeah, it's a tough pill to swallow on paper.
Which is actually worse than the $290 million loss they reported at the exact same time last year.
Right.
I know we teased this, but we have to unpack it thoroughly. How does a 59% operating margin turn into a $500 million black hole?
Okay, the culprit is entirely found in the I and the D of that EBITDA acronym we just discussed.
Interest and depreciation.
Exactly. CoreWeave is bringing in massive amounts of cash, but they are expanding their physical footprint at an unprecedented rate.
Like historically unprecedented.
They're acquiring land, building massive data center shells, buying tens of thousands of incredibly expensive NVIDIA graphics processing units.
And all the cooling equipment, right?
Yes, installing miles of networking cables, constructing industrial-scale liquid cooling systems. It's heavy construction.
And all of that falls under capital expenditures, or CapEx, in financial terms.
Correct. When a company spends billions of dollars on physical hardware, accounting rules, specifically GAAP accounting, do not allow you to just write off that massive expense on the day you buy it.
Wait, really? Even if the cash left the bank account?
Even if the cash is gone, you have to depreciate the cost over the useful life of the equipment.
Oh, I see.
So if a server is expected to last 5 years, you take a portion of its purchase price and record it as an expense every single quarter for 60 months.
Okay, so to be clear for everyone listening, a depreciation expense on the income statement doesn't mean cash is leaving CoreWeave's bank account today.
Right.
The cash left the building months ago when they bought the server, but the accounting rules force that expense to haunt the profit and loss statement for years.
You've got it perfectly. It is a non-cash expense dragging down the net income. But the second factor, that the interest, is very much a real cash expense.
Right, because they have to borrow to build all this.
Exactly. To buy those billions of dollars of servers before the customer revenue actually arrives, CoreWeave has to borrow.
And that's not cheap right now.
Not at all. The interest expense for Q2 alone was $640 million.
Wow. Just on interest.
Just interest. And if we look at the source data, that's up from just $267 million in Q2 of the prior year. That massive interest burden is what pulls that $1.5 billion operating profit down into negative territory.
This is the fundamental tension you have to understand if you're going to put your money into a company like this. It requires a complete mental shift regarding cash flow.
It really does. It's not a software company.
Right. CoreWeave signs these 5-year contracts with their enterprise clients. The client agrees to pay a set monthly fee for the compute power over those 60 months. So the revenue is incredibly predictable.
Highly predictable, but distributed over time.
Yet CoreWeave has to buy the physical computer today. The cost is massively front-loaded while the revenue trickles in.
Yeah, that's a squeeze.
Let's try to visualize this. It reminds me of the economics of real estate development, specifically like building an ultra-luxury apartment tower.
Oh, that's a great analogy. Let's follow that. The capital dynamics are remarkably similar.
So as the developer, you go hundreds of millions of dollars into debt before you ever see a dime of rent.
Right.
You buy the land, pour the concrete, pay the construction crews, install the high-end fingeries. You are taking out massive loans, and your interest payments are eating you alive.
Just bleeding cash.
For the first 2 or 3 years, your income statement is an absolute disaster. You are hemorrhaging cash on paper.
And if an outside observer only looked at your net income during the construction phase, they would think you were running a terrible business heading for bankruptcy.
Exactly. But the crucial detail is that before you even finish pouring the foundation, you pre-leased 100% of the apartments to high-net-worth tenants on 5-year ironclad leases.
Which brings us to the most staggering number in the entire earnings call.
The backlog.
The backlog. CoreWeave reported a contracted revenue backlog of $104 billion.
The pre-signed leases.
Exactly the equivalent. And the CFO, Nitin Agarwal, noted they added another $25 billion in net new customer commitments just in the early weeks of Q3.
Which isn't even officially in that Q2 backlog number yet.
Right. So we're really looking at roughly $129 billion in legally binding future revenue.
That is the GDP of Morocco, just sitting there in a spreadsheet waiting to be collected.
It's hard to wrap your head around.
So, applying the real estate analogy, CoreWeave is taking massive losses today because they're paying the interest on the construction loans and depreciating the cost of the building. But the tenants are already locked in.
Yes.
The rent checks are mathematically guaranteed.
The CFO actually spoke to this directly on the call, too. He addressed how the debt is structured over the life of these specific contracts.
Oh, right. He provided that breakdown of unit economics.
Yeah, it was really illuminating. He explained that a typical 5-year contract requires heavy debt to finance the initial build-out.
Because the servers are expensive.
Extremely. However, the cash flow generated by that specific deployment fully repays the asset-level debt used to fund it well before the contract ends.
Oh, so they pay off the loan using the revenue from that specific server.
Exactly. And they still generate significant free cash flow along the way.
Okay, that is a vital detail. So by the time we hit, say, year 4 or 5 of that contract, the specific loan they took out to buy those servers is completely paid off.
The leverage drops to 0. The mortgage on the apartment building is paid off, but the tenant is still paying the same high monthly rent.
Which means the margin on that server in year 5 is basically pure profit. The depreciation is mostly done, the interest is gone, and the revenue just falls straight to the bottom line.
This is exactly why reacting to the headline net loss is a rookie mistake in infrastructure investing.
Right. You're missing the forest for the trees.
If CoreWeave decided tomorrow to stop growing, if they halted all new construction and just sat on their current servers, their capex would plummet, the debt would start clearing, and they would instantly become one of the most profitable companies on Earth on a net basis.
Wow. But they won't do that.
No. Doing so would mean surrendering the market to their competitors.
They are choosing to bleed on the bottom line today to conquer the market for the next decade.
Precisely.
So for the retail investor listening to this, the takeaway is clear. You have to look past the red ink. Your focus has to be on the EBITDA margins, the sequential revenue growth, and that gargantuan backlog.
It's the only way to accurately evaluate their momentum. And that momentum is being driven by physical scale, which is the next area the earnings call focused on heavily.
Yeah, let's pivot to that.
The sheer footprint they're establishing is difficult to comprehend.
I'm glad we're moving to the physical reality of this because the numbers here honestly sound like science fiction. Let's look at the raw data regarding their power capacity.
Okay.
CoreWeave reported hitting 1.5 gigawatts of active power. Let me just pause there for you listening at home. We are talking about gigawatts.
That's unbelievable.
That is a measurement scale normally reserved for hydroelectric dams or nuclear power plants.
Right. To give you a sense of scale, 1 gigawatt is generally estimated to be enough electricity to power about 750,000 average homes.
Oh my God.
CoreWeave is drawing 1.5 gigawatts purely to keep their AI servers running and cooled.
And the growth rate of that power draw is what really stands out. They added nearly 500 megawatts of active power in the second quarter alone.
It's a massive acceleration.
The CEO, Mike Schrader, was very pointed about this. He stated that adding 500 megawatts in a single quarter is more power capacity than any single neocloud competitor operates in their entirety today.
Think about that. They are essentially building the equivalent of a competitor's entire business every 3 months.
That's insane.
And a crucial detail hidden in the transcript. 300 megawatts of that Q2 addition came online in the month of June alone.
Oh, wait. So because it came online at the very end of the quarter, the revenue generated by that massive June power bump won't even meaningfully show up until the Q3 earnings report.
Yes. The Q2 revenue number, as massive as it is, that $2.6 billion, is actually a lagging indicator of their true operational size today.
This massive scale, combined with what seems like an insatiable demand from the market, gives them leverage that most companies can only dream of.
The pricing power here is absolute.
Yeah, the transcript noted they implemented an approximate 25% price increase across their individual product offerings, their SKUs, in July.
A 25% price hike in a single month.
I mean, think about that from a consumer perspective. If a streaming service raises their monthly fee by $2, there is outrage. People cancel their subscriptions.
Oh, there are boycotts.
CoreWeave raises their prices by 25% on enterprise contracts that cost millions of dollars, and the customers just nod and sign the paperwork.
Because they have no other choice. The CFO was incredibly blunt about the market dynamics.
What did he say?
He explicitly stated they are seeing demand from multiple customers for each GPU we bring online.
Wow. So they're turning people away.
They are not dealing with a sales problem. They do not have account executives cold calling companies trying to convince them to buy AI compute.
The customers are banging on the doors.
They're managing a wait list. When you have 3 Fortune 500 companies fighting over a single cluster of NVIDIA chips, you dictate the terms, you dictate the duration of the contract, and you certainly dictate the price.
But it's not just about renting out raw bare metal hardware. The call spent a lot of time discussing the software layer they're building on top of the physical chips.
Right, the platform side.
Specifically, their managed inference platform. The numbers here are just wild. The annual recurring revenue, or ARR, for this managed inference platform went from $1 million to over $100 million in a matter of months.
That is the kind of explosive vertical growth curve that software startups build entire investor decks around, and CoreWeave is treating it almost as a value-add service on top of their core infrastructure.
Let's define inference for the listeners, because this word was used constantly throughout the call.
Constantly.
And it represents a massive shift in where the entire AI industry is heading.
It really does. To understand inference, you have to look at the first phase of the AI boom, which was entirely focused on training.
Okay, training.
For the last few years, companies were buying massive amounts of computing power to train foundational models. Think of training like sending someone to medical school.
Okay, I like this analogy.
It takes years, it is incredibly expensive, and it requires a massive concentration of resources. You feed the model billions of data points until it learns how to process language or recognize images.
It's a massive, one-time, highly intensive burst of calculation.
But once the model is trained, once the student graduates medical school, they have to go out into the real world and actually diagnose patients.
Right. They have to do the job.
That is inference. Inference is the trained model taking in new real-world data, thinking about it based on its training, and generating a response or a decision.
And the economics of inference are fundamentally different than training.
Completely different.
Training is a capital expense. You do it once, maybe you update it once a year. But inference is an operational expense. It never stops.
It is a continuous compounding loop. Every single time you ask a chatbot a question, that is an inference workload. Every time an algorithm flags a fraudulent credit card transaction, that is inference.
The CEO gave some really tangible examples on the call that pull this out of the abstract realm of chatbots and show how inference is invading heavy industry.
Yeah, the enterprise use cases are fascinating.
The Caterpillar partnership is a perfect example.
That was a standout mention. Caterpillar is deploying NVIDIA's new Vera Rubin platform on CoreWeave's infrastructure.
They're using CoreWeave's AI cloud as a continuous data factory. They are training specialized models to enhance the intelligence of autonomous construction equipment.
Right.
We are talking about self-driving bulldozers, massive excavators operating in unpredictable environments.
Consider the data loop required for an autonomous bulldozer. It is operating on a live construction site.
It's chaotic.
Very chaotic. It encounters a new type of dense clay, or it detects a strange vibration in its hydraulics. That real-world sensory data is transmitted back to the CoreWeave cloud.
Okay.
The model analyzes it, figures out a more efficient way to dig or a safer way to operate, and pushes that updated intelligence back out to the bulldozer.
And that loop happens continuously across fleets of vehicles 24 hours a day.
It requires a permanent, always-on connection to immense computing power. The requirement for compute doesn't end when the bulldozer is built. It becomes a permanent utility cost for Caterpillar to keep that machine intelligent.
The call also highlighted the life sciences sector as a massive growth driver for inference.
Oh, absolutely.
They mentioned a new customer, Isomorphic Labs. Their stated corporate mission is literally to solve all disease.
Ambitious.
Very. They are using AI models to map complex biology, predict protein folding, and discover entirely new pharmaceutical drugs.
And that is not a simple query. That requires running millions of complex biological simulations simultaneously, day and night.
Or look at the financial sector. The CEO called out Flow Traders and IMC, two massive systematic quantitative trading firms.
Huge players.
They are moving the next generation of their trading models onto CoreWeave. In quantitative trading, an inference model is looking at global market data and making trading decisions in microseconds.
Right, speed is everything there.
A millisecond of latency or downtime can mean the difference between making millions or losing millions.
When AI becomes embedded into the core operations of hedge funds, drug discovery, and heavy construction, the computing power is no longer an experimental R&D budget item.
What does it become?
It becomes mission-critical infrastructure.
Which fundamentally shifts the narrative of the entire company. CoreWeave isn't just selling a one-off cluster of servers for a science project.
No.
They are laying the basic electrical grid for the next iteration of the global economy.
And this shift toward inference explains what is perhaps the most surprising and counterintuitive data point in the entire earnings transcript.
Yes. The older hardware.
It has to do with older hardware, exactly.
The A100 chips. We always hear about the desperate race for the bleeding edge. Everyone wants the NVIDIA H100s, and now they're clamoring for the upcoming Blackwell and Vera Rubin architectures.
The media narrative is entirely focused on the newest silicon.
But the CFO explicitly noted that CoreWeave is successfully recontracting older architecture. Specifically, he highlighted the NVIDIA A100.
Right.
For context for you listening, the A100 chip was introduced back in 2020. In the timeline of semiconductor technology, 4 years is an eternity.
A lifetime.
A chip from 2020 is generally considered ancient history by tech standards.
Yet CoreWeave just signed a contract to lease out an A100 cluster all the way out to the year 2029.
And the CFO added that they are doing so at highly attractive prices. The average selling prices, the ASPs, on this older generation of chips remain at levels they were seeing a full year ago.
The market is barely discounting them.
This is where understanding the mechanics of inference becomes critical. Why would a company pay a premium for a 2020 chip in 2026?
Because inference workloads often have a different hardware profile requirement than training workloads.
How so?
Training a massive new language model requires raw, brute force computational power. You need the newest chip. But inference is often bottlenecked by memory bandwidth, how fast the chip can access the data it already holds, rather than pure calculating speed.
So an older chip like the A100 is still perfectly capable and highly efficient at running massive amounts of day-to-day inference workloads for enterprise clients.
Let's use an analogy. Imagine a massive logistics company like Amazon or FedEx. They need vehicles to deliver packages.
Okay, I'm following.
The newest NVIDIA chip, the Blackwell, is like a multi-million-dollar custom-built Formula One race car. It is the absolute fastest machine on the planet.
Right.
If you are entering a race or training the world's most advanced AI model, you must have the Formula One car.
Makes sense.
But if your goal is just to deliver thousands of cardboard boxes to suburban neighborhoods every single day, which is what inference essentially is, you don't need a Formula One car.
You'd probably ruin it.
Right. In fact, it would be a terrible waste of money. What you need is a reliable, sturdy fleet of commercial delivery vans.
An A100 is that delivery van.
The A100 is the delivery van. It does the day-to-day job perfectly.
And because there's a massive shortage of both race cars and delivery vans in the market, companies are willing to lease a 4-year-old delivery van for near top dollar just to ensure they can keep their business running.
And here is where we tie it back to the financial paradox we discussed earlier. Remember our apartment building analogy where the mortgage gets paid off, but the tenant keeps paying rent?
Oh, the A100s are the fully paid off apartment buildings.
Precisely. CoreWeave bought those A100 chips years ago. The capital expenditure is in the past.
Right.
The debt attached to that specific hardware has likely been retired or massively paid down. The depreciation schedule is nearing its end.
So every single dollar of rent they collect on those A100 clusters between now and 2029 drops almost entirely to the bottom line as pure, unadulterated operating profit.
It is the ultimate cash cow. They are executing a dual-engine growth strategy.
Capturing the high end and the trailing edge.
Exactly. They capture the premium bleeding edge market with their new Vera Rubin deployments, and they maximize the trailing edge margin by keeping the older A100s fully utilized at high prices.
It's a brilliant capitalization of a supply-constrained market. But what happens when we look ahead? The earnings call didn't just dwell on the past quarter. They provided forward guidance that frankly makes the Q2 numbers look small.
The guidance is where the ambition of the management team is fully revealed.
Let's lay out the raw data they provided for the remainder of 2026. They raised their full-year revenue guidance to a range of $12.4 billion to $13.2 billion.
A massive upward revision.
And they bumped their end-of-year exit ARR, their annualized run rate for recurring revenue, up to a range of $18.5 to $19.5 billion.
Wow.
They expect to enter 2027 running at a pace of nearly $20 billion a year.
The momentum is compounding.
But then we hit the CapEx guidance, and this is where the vertigo sets in again.
Brace yourself.
They raised their full-year capital expenditure guidance to a staggering range of $35 billion to $39 billion.
$39 billion in a single calendar year.
I mean, they're going to spend the equivalent of the gross domestic product of Iceland just buying servers, cables, and concrete this year.
It's unbelievable.
How on earth does a company finance that? You don't walk into a local bank branch and ask for a $39 billion commercial loan.
No, the teller would laugh you out of the building. To fund that level of physical expansion, you have to tap into the global capital markets in a sophisticated way.
Right.
The CFO detailed how they raised roughly $18 billion in Q2 alone, They utilized a complex mix of debt instruments, convertible notes, and equity raises.
That brings their total secured capital pile to over $32 billion.
Yes.
Okay, I have to play the skeptic here for the retail investors listening. This is the part that keeps people up at night.
Sure. Let's hear it.
I look at this guidance, and I see a company planning to spend up to $39 billion, carrying over $32 billion in secured debt and capital obligations. What happens if the music stops?
Right. The doomsday scenario.
If the AI demand curve flattens even slightly, aren't they left holding the most expensive bag of rapidly depreciating computer chips in human history?
It is the single most important risk factor to consider. If the demand evaporates, the debt remains.
Exactly.
But the earnings call provided a very specific piece of data regarding how this debt is structured, which suggests the institutional credit markets view that risk very differently than a retail investor might.
What did they point out?
The CFO highlighted a specific financing mechanism called the DDTL.
The DDTL. I'll admit, when I first read that, it sounded like a banned pesticide from the 1970s.
Yeah.
What exactly is a DDTL?
It stands for Delayed Draw Term Loan. This is a specialized instrument used in corporate finance, typically for massive infrastructure projects.
Okay.
Normally, when you or I take out a loan, the bank hands over the entire lump sum of cash on day one, and we immediately start paying interest on the full amount.
Which makes sense for buying a house, but maybe not for a multi-year construction project.
Exactly. If CoreWeave borrows $1 billion to build a data center, they don't need all that cash on day one.
Right, the concrete hasn't even been poured.
They need it in tranches over 12 months as construction milestones are hit. A delayed draw term loan allows them to secure the $1 billion credit line up front, guaranteeing the funds are available.
Oh, I see.
But they only draw down the cash and, critically, only start paying interest on it as they actually need to pay the vendors.
So it prevents cash drag.
Yeah.
You aren't paying 8% interest on hundreds of millions of dollars that are just sitting idle in a corporate checking account waiting for the servers to be delivered.
It is a highly efficient way to manage treasury operations at scale.
That makes a lot of sense.
But the true significance of the CFO's comments wasn't just the use of a DDTL. It was the specific nature of this latest one, which he called DDTL 5.5.
What makes version 5.5 so special?
He noted that this loan, syndicated in the public markets, was structured for the first time to allow CoreWeave to finance shorter duration customer contracts.
I need you to break down why the duration of the customer contract matters to the syndicate of banks issuing the loan.
Historically, banks are inherently conservative. If they were going to lend CoreWeave hundreds of millions of dollars to buy NVIDIA chips, they demanded absolute certainty.
They want a sure thing.
Right. They wanted CoreWeave to show them a 5-year, ironclad take-or-pay contract from a massive, credit-worthy tech giant, a hyperscaler.
Okay.
The bank wanted mathematical proof that the contracted revenue would cover the debt payments.
But the market is evolving. Not every customer is a hyperscaler willing to lock in for half a decade.
Precisely. The enterprise market, a mid-sized pharmaceutical company, a regional logistics firm, a large retail chain, they want to deploy AI, but they're terrified of technology lock-in.
Because hardware evolves too rapidly.
Exactly. An enterprise CIO does not want to sign a 5-year contract for compute. They want the flexibility of a 2-year or 3-year agreement.
And until now, CoreWeave couldn't easily finance the hardware for those shorter deals because the conservative banks wouldn't underwrite the loan without a 5-year guarantee.
But the successful syndication of DDTL 5.5 proves a massive psychological shift in the credit markets.
Oh, wow.
The institutional lenders have become so confident in the underlying intrinsic value of CoreWeave's physical infrastructure and so confident in the sheer depth of the market demand that they are now willing to lend against a 2-year enterprise contract.
Because the banks believe that even if that enterprise customer leaves after 24 months, CoreWeave can simply turn around and rent that exact same server to someone else on the waitlist the very next day.
Yes. The hardware itself is now being viewed as hard collateral, almost with the same stability as prime commercial real estate.
That's a huge shift in perception.
The CFO made a point to mention that this specific transaction priced during one of the most volatile, dislocated weeks for credit markets this year. Yet it was still met with overwhelming demand from lenders.
And he also mentioned a substantial reduction in their overall cost of borrowing, didn't he?
Yes. Despite taking on tens of billions in new obligations, CoreWeave managed to reduce their weighted average cost of debt by nearly 300 basis points over the trailing 12 months.
Let's do the math on that for the listener. A basis point is 0.01%. So 300 basis points is a 3% reduction in their interest rate.
Exactly.
If they were paying 10%, they're now paying 7%.
And when you apply a 3% reduction to a multi-billion-dollar debt load, the savings are astronomical.
It is massive.
The CFO noted this translates to approximately $1.1 billion in annualized interest savings.
They are borrowing massively more money, but the market views them as significantly less risky today than a year ago. So the money is much cheaper.
It's a virtuous cycle for them right now.
It really reinforces the idea that Wall Street isn't treating them like a speculative tech startup anymore. They are treating them like an established utility provider.
Which is the perfect transition to the physical constraints of being a utility. You can have all the financing in the world, but you still have to build the power plants.
Sure.
And during the Q&A portion of the call, analysts brought up the growing friction in the real world. Regulatory pushback, and the limitations of the power grid.
The NIMBY factor.
Yeah.
Not in my backyard.
Exactly.
We are seeing headlines constantly about local communities pushing back against massive data centers. People are realizing these facilities draw absurd amounts of electricity and water, and nobody wants a giant humming concrete box draining their local municipal grid.
The CEO's response to this was very pragmatic. He didn't dismiss the reality of local pushback.
What do you say?
He openly acknowledged that certain municipalities have instituted moratoriums on new data center construction. But his core thesis is that local zoning laws do not destroy the macro demand for AI. They merely dictate geography.
Capital is like water. If one town dams it up, the capital will just flow downhill to the next county or state that is willing to accept it.
He stressed that navigating this requires hyper-collaboration with local governments and utility providers.
You can't just bully your way in.
No, a data center operator cannot just show up and expect the local utility to subsidize their power needs. You have to bring your own capital to upgrade the substations and the transmission lines so you don't negatively impact the rate base for local residents.
And you have to clearly demonstrate the tax revenue benefits.
Exactly. But importantly, he assured investors that this friction is not slowing down their near-term roadmap.
Okay, good to know.
He stated that none of their current growth targets, specifically their goal to hit 8 gigawatts of power by 2030, are compromised by the current regulatory environment.
Because they have already secured the vast majority of what they need for the next few years. He noted they have 4.2 gigawatts of power officially contracted today.
Yes. Plus, he mentioned another 1.5 gigawatts in powered land options and signed letters of intent.
So they have line of sight to nearly 6 gigawatts of power right now. They are not scrambling to find land. They are already pouring concrete on it.
And their geographical strategy is adapting. They aren't just fighting for space in traditional data center hubs like Northern Virginia.
Where else are they going?
They are expanding globally, going wherever the power surplus exists. The call highlighted a major expansion in Indonesia, with 360 megawatts coming online there in the next 18 months.
It highlights the incredible logistical complexity of this business. They are orchestrating a global supply chain spanning real estate acquisition, high-voltage electrical engineering, industrial cooling, and semiconductor deployment.
It is an execution play on a global scale.
All right, we have covered a massive amount of territory today. We started with the jarring optical illusion of a $600 million net loss.
Unpack that completely.
We walked through the mechanics of capital expenditures and depreciation, unpack the seismic shift from AI training to continuous inference, and explore the sophisticated financial engineering keeping this rocket ship fueled.
A lot to digest.
It is time to bring it all together for the outro. We promise our listeners a verdict that is opinionated, data-driven, and actionable. So when we synthesize all the noise from this Q2 call, what is the definitive signal?
Taking all data into account, the signal is solidly cautiously bullish.
Cautiously bullish. Let's break that down into the why. Defend the bullishness first.
The bullish case rests entirely on the depth and width of the moat CoreWeave has constructed. It is practically insurmountable for a new entrant.
The backlog, right.
That $104 billion backlog represents guaranteed, contractually obligated future cash flow. You combine that with the 4.2 gigawatts of secured contracted power, and you have a physical barrier to entry that no amount of software innovation can bypass.
2 kids in a dorm room cannot disrupt CoreWeave.
No, you can't code your way to a gigawatt of electricity. You need tens of billions of dollars in capital, years of lead time to navigate utility interconnection queues, and the logistical expertise to build the facilities.
And their pricing power is currently absolute, validated by the 25% price increase the market readily absorbed. They are the premium incumbent provider in a market defined by severe supply constraints.
Exactly.
And the caution. What keeps the bullish from being unconditionally bullish?
The sheer execution risk and the weight of the balance sheet. Managing a $39 billion CapEx spend in a single 12-month period is a logistical high-wire act.
Definitely.
They are entirely dependent on highly complex, fragile global supply chains. A strike at a major port, a delay in specialized cooling equipment, or a disruption in fiber optic cable supply could stall a deployment, delaying revenue recognition and squeezing their cash flow.
And the $32 billion in debt and obligations is always hovering in the background.
If the enterprise demand for AI inference were to suddenly flatten, if companies realize AI isn't yielding the ROI, they expected that debt burden would become a crushing weight very quickly.
So for the retail investor listening right now who either holds CoreWeave or is looking at an entry point, what is the actionable framework? How should they mentally categorize this stock in their portfolio?
The most vital piece of advice is a fundamental recategorization of the asset. You must stop viewing CoreWeave as a nimble, high-margin SaaS software company.
Don't treat it like a software stock.
Do not value them like you would value a Zoom or a Salesforce. You must view them as a hyper-growth, incredibly capital-intensive utility provider.
A utility company for the artificial intelligence age.
Yes. You are investing in the modern equivalent of the companies that laid the transcontinental railroads in the 1860s or built the physical electrical grids in the 1920s.
That makes total sense.
Foundational infrastructure requires astronomical upfront capital expenditures and heavy debt loads. That is the cost of entry. So when you read their next earnings report, ignore the headline net loss.
Focus on the real metrics.
Focus relentlessly on the EBITDA generation, the health of the backlog, and their ability to bring new megawatts of power online on schedule.
That framing completely changes how you read the balance sheet. I think that is incredibly valuable for our listeners.
It requires patience and an understanding of physical depreciation.
Before we close out this deep dive, I want to leave our listeners with one final provocative thought to mull over, something that builds on the data we discussed, but points to the horizon.
What do you have in mind?
We spent time detailing the incredible profitability of the older A100 chips. CoreWeave is successfully leasing 2020 architecture out to the year 2029 because the inference market is starved for capacity and those chips perform adequately.
The fully paid off apartment buildings.
Right. But the technology sector is ruthless. We are assuming a linear progression of hardware. What happens if the AI hardware industry hits a sudden, discontinuous leap in efficiency?
A true paradigm shift in silicon architecture.
Imagine a scenario where a competitor, or even NVIDIA themselves, releases an architecture next year that fundamentally changes the physics of compute. A chip that is exponentially faster, but more importantly, requires a fraction of the electricity to run.
Wow, yeah.
It drops the cost of inference by 90%.
The economic calculus changes overnight.
If that happens, does that $104 billion backlog hold up? Do enterprise customers continue to pay premium lease rates for the 2020 A100 chips out to 2029 if they realize they are essentially renting incredibly expensive, power-hungry paperweights?
That's a scary thought.
Or does the market suddenly break those contracts, leaving CoreWeave holding billions of dollars in outdated silicon that nobody wants to run inference on, regardless of how cheaply it's priced?
It is the ultimate existential risk for technology infrastructure. When a developer builds a concrete apartment building, the concrete does not become technologically obsolete in 3 years.
Right.
People will always need a physical place to sleep. But in the data center world, silicon ages in dog years.
And that is the tightrope they are walking. We started this deep dive acknowledging that looking at CoreWeave's financials is like trying to read a murky diagnostic scan.
It really is.
You go in looking for the clean, straightforward X-ray of traditional profit and loss. But instead, you are presented with a highly complex, interconnected, real-time map of a company attempting to physically construct the future.
It's messy.
It is messy, it is phenomenally expensive, and it requires an entirely new financial vocabulary to decipher. But if you can learn to read that map, the upside potential is practically unrivaled in the public markets today.
Definitely.
Keep your eyes locked on that CapEx, monitor the sequential growth of the backlog, and watch how the hardware lifecycle plays out. That wraps up this Talk Tickers deep dive. Keep your portfolio sharp, and we will catch you on the next call.